Welcome to this edition of IBFD's Tax Takes, News and Views, bringing you the week's tax news in a nutshell. I'm Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. With me for our Beyond the News interview is Barry Larking, Special Counsel at IBFD in Amsterdam. On today's show, COVID. We examine some steps that countries are taking to handle the next wave of the pandemic. Some good news about Brexit, for a change. And the United States settles one very old score and tries to settle some new ones over abusive tax shelters. These and more, including Barry Larking's interview with Angela Simons, Head of International Business Tax at Her Majesty's Treasury in the UK, coming up on IBFD's Tax Takes. First, we turn to the top news of the past week, as reported in IBFD's Tax News Service. As winter approaches and the COVID virus surges across the Northern Hemisphere, countries have extended and expanded existing relief and begun planning for the expected arrival of vaccines and other treatments next year. In that vein, the European Commission has extended to the end of next April its temporary relief from customs duties and VAT on the import of medical devices, medical supplies, and protective equipment. And to further reduce the enormous future cost of tackling the pandemic, the Commission proposes to apply a reduced or zero VAT rate on COVID-19 vaccines, in vitro diagnostic medical devices, and related services. Russia has clarified that employers may deduct the cost of COVID testing, and that employees may exclude the value of that testing from their taxable income. South Africa, on the other hand, has granted relief to a different group of workers, those who normally spend more than half the year working outside the country, but cannot do so this year because of travel restrictions. They now need to spend only 117 days away in 2020 instead of the usual 183. And in Colombia, the Supreme Court giveth and the Supreme Court taketh away, ruling that the Constitution does give the government the power to grant COVID-19 driven tax relief to the cultural and creative sector, but not to grant COVID-19 relief from local tax requirements. While most of the world has been focused on the UK government's recent moves to circumvent aspects of the Brexit deal reached with the EU last year, there is some good news about the world's longest running and perhaps most expensive divorce. The EU-UK Joint Committee has agreed on the first joint implementation report on residence rights. The report provides an overview of implementation progress on residence status and related documentation in line with the withdrawal agreement between the EU and the UK. And to ensure a smooth transition for the exchange of goods between the EU and the UK, while maintaining an open border for goods to pass freely between Ireland and Northern Ireland, Her Majesty's Revenue and Customs has published a policy paper outlining the VAT accounting processes that will apply to goods moving between Great Britain and Northern Ireland when the divorce becomes final on January 1, 2021. One driving force behind Brexit was the argument that it would allow the UK to cut better bilateral trade deals than it could reach as part of the EU. Well, the UK just reached its first trade deal, a comprehensive economic agreement with Japan, that when fully implemented could boost trade between the two countries by £15 billion per year. And that deal could lead to an even bigger boost to British trade, possible entry into the Trans-Pacific Partnership. Turning to the US, many young tax professionals were barely out of diapers in 1993 when insurance giant AIG entered into a series of transactions with foreign banks designed to generate foreign tax credits to reduce its U.S. income tax liability. Last week, a federal judge in New York approved a settlement of a 2012 lawsuit over those credits after the Department of Justice developed, quote, overwhelming evidence that the transactions lacked any meaningful economic substance, were devoid of any legitimate business purpose, and were instead designed solely to manufacture hundreds of millions of dollars in tax benefits to which AIG was not entitled. Under the settlement, AIG agreed to give up a whopping $400 million in tax credits and pay a 10% penalty. Fast forward to 2020 as the IRS continues to identify abusive tax shelters. Latest on its radar, a shelter involving micro-captive insurance companies designed to generate huge fake tax deductions for small businesses. The IRS recently announced a limited time only settlement offer, allowing some taxpayers to achieve certainty and limit their exposure. Time will tell whether this approach will reach the same level of success as some of the IRS's earlier settlement initiatives. In other news, following its neighbors in the Gulf Cooperation Council, Oman will introduce a VAT at 5% or 0% to take effect in mid-April 2021. The European Commission has adopted a work plan for 2021 proposing incentives to reduce carbon emissions and including a commitment to achieve a fair tax system that leaves open the possibility of an EU-wide digital levy. Joining most of its Southeast Asian neighbors, Cambodia has approved participation in a free trade agreement between the Association of Southeast Asian Nations and Hong Kong. And finally, in Pakistan, a high court in Sindh province has ruled that the government may not select a taxpayer audit twice for the same tax year, applying the concept of double jeopardy, which is often limited to criminal matters. Now we go beyond the news for Barry Larking's interview with Angela Simons, Head of International Business Tax at Her Majesty's Treasury in the UK. Barry.
Thank you, Stuart. I'm Barry Larking, Special Counsel here at the IBFD, and I'm joined today by Angela Simons, who is not only Head of International Business Tax at Her Majesty's Treasury in the United Kingdom, but in that capacity has also been intimately involved with discussions on all fronts on the question of digital and global tax reform. So Angela is the ideal person to give us some insights into how the OECD blueprints are playing out in the UK. Angela, welcome.
Thank you, Barry, and thank you for inviting me today to talk to you on the IBFD Tax Takes platform.
Great, it's great to have you here. Let's start with the big picture. What is the UK government's position with regard to Pillar 1 and Pillar 2?
Barry, our position on this has been very clear from the start. We're one of the G20 countries that gave the OECD a mandate to look at solutions for the tax challenges that digitalization of the economy has created. The recognition that a solution is needed isn't new. This stems back to 2013. But what is new is that we have blueprints. We have a blueprint for a solution on Pillar 1, and we see that work as a priority. We see it as absolutely essential that any multilateral solution focuses on Pillar 1. That is what is going to ensure that a greater share of the profits of large digital businesses are taxed in the countries where they make sales. Now, Pillar 2 is important to some. We recognize that, and we recognize that a global solution is going to need to include outputs on Pillar 2 as well. And we're working to make sure those outputs are balanced and those outputs are appropriately targeted. And that is the UK government's position.
So basically, the UK accepts the idea of a political package of Pillar 1 and Pillar 2, where the two cannot be separated.
Barry, the G20 mandate's quite clear. The G20 mandate is for work on Pillar 1 and Pillar 2 to progress and the work to go forward together. We see that Pillar 1 is a priority, and of course we recognise the importance that others place on Pillar 2, and we look at it as part of the package.
Okay, well look, if both pillars do go ahead, the estimates are from the OECD that there is an annual increase in global revenue of around 4, or potentially of around 4%, or that equates to around 100 billion US dollars. How realistic are those figures?
That's certainly a good question. I'd say that it's very difficult to accurately predict the revenue impacts with any great degree of accuracy. Just setting aside the challenges of taking a macro level approach, we now have COVID, and that presents issues in itself, and we're yet to see its full impacts. But even setting that aside, there's a huge question about what the behavioural impacts of the OECD framework might be if those rules are implemented widely.
Right, and what are we talking about? Whose behaviour by multinationals or by governments?
So yes, both, in fact, because the behavioural responses from multinationals and governments that we might expect to see would have a significant impact on the end revenue gains. And it's hard to judge or predict those. For example, take Pillar 2. you might legitimately expect to see behavioural impacts on expected revenue gains as a result of multinationals restructuring or rethinking their location decisions. But you might also legitimately expect to see jurisdictions considering their choice of tax design, tax rates, or even tax mix. What the behavioural responses of businesses and governments might be is hard. You can't predict it. It's very difficult to do so with any degree of accuracy. And
Right.
it's equally hard to predict the impact accurately for Pillar 1.
Right, I can see that that behavioural impact might have an impact on, or behavioural change might have an impact on the total revenue gains from the two pillars. But I can imagine that the behavioural changes may also impact on the way that if we assume that it's 4% of global revenue gets distributed around the globe. That means that there are going to be winners and there are going to be losers, probably. What's your vision from the UK's end? Do you think that UK's is likely to end up as a winner or a loser in this?
So firstly, we don't know if it's this 4%. As I said, that's hard to predict. We don't know if it's what the overall percentage revenue gain would be. We don't know what the distribution of that gain would be. You talk about winners and losers, and you talk about that in terms of pure revenue gain. Well, I wouldn't. But before I go on to that, I'd say, yes, you'd expect some revenue gains for the UK, but that's hard to predict. But as I was saying, you can't just look at it in terms of pure revenue gain. I think we should be taking a step back here and considering the wider picture and broader benefits that we all stand to gain. Where we all see huge benefits is in reaching a global agreement on a multilateral solution for lasting rules that address long-standing issues with digitalisation. We'd achieve much needed change to modernise the international tax landscape and a new framework that's designed multilaterally. And that'd be a framework that's designed with the aim of being proportionate, avoiding administrative burdens or double taxation, whilst also being mindful of the impact on countries' tax policy choices.
Okay, so those are the aims. That's the position, assuming Pillar 1 and Pillar 2 go through. Now, we know that the consensus that was hoped for in October hasn't been reached. How is the UK going to react to that? What options are available to it? And in particular, what's it going to do about its DST, which came into effect halfway through this year?
So, Barry, the OECD work will continue. There's no doubt about it. We've just had the G20 finance ministers meeting back in October, and they've made it clear that they are committed to work on both pillars with a view to reaching a global consensus-based solution by mid-2021. We should focus on that. We should focus on continuing to make progress. Now, you asked about our DST. Well, in the meantime, we, along with a number of other countries, have got our DST in place, which applies to revenues earned from 1st of April 2020. It's possible or likely that if we don't get a global solution by mid-2021, then many more countries are going to be taking this path or increasing the breadth of existing measures.
Sorry to interrupt. Maybe I can just sort of butt in there. In that scenario, the question that is going to arise inevitably is going to be, what will the US position be? We know that the US is currently investigating a number of DSTs around the world. Will that influence the position?
That doesn't change the position. It doesn't change the general recognition about limitations in the current international corporate tax framework as it's applied to digital businesses. It doesn't change the recognition that's been evidenced by the G20 mandate that a multilateral approach is needed to address those challenges. That is what Pillar 1 seeks to address. It's intended to address the motivations behind the unilateral measures that jurisdictions have sought to introduce, and achieving a multilateral solution is a priority and our preferred solution. And the trade investigation serves to clearly illustrate that the counterfactual, i.e. the position absent a multilateral solution, is not going to be a satisfactory or stable one. So it simply strengthens the case for a global solution, albeit not in a way that means the UK will be forced into a solution that fails to address our core concerns.
Right, okay. And talking of the UK's core concerns, to what extent are they going to be impacted by Brexit? The fact that the UK will, going forward, not be a member of the European Union. Does that give it more room for manoeuvre or less?
What's leaving the European Union got to do with this? It has got nothing to do with our commitment to tackling the issues with digitalisation. Our resolve on that remains as before. And when it comes to international efforts to address tax avoidance, we've led on the OECD BEPS projects, including on its implementation. Leaving the European Union doesn't change our principled position in that regard. Getting a multilateral solution to address digitalisation is a priority, and we're not the only ones. It's an international priority. You might wonder about the UK's influence on the work and whether our collaboration with the European Union member states like France, Italy and Spain, who have been big advocates on Pillar 1 and digital service taxes, will continue post 1st of January 2021. That shouldn't be a concern. Firstly, we continue to work very closely with European Union member states. We don't need to be involved in European Union Council discussions, and we haven't been for some time, but we expect that our close working is going to continue. And secondly, it's our G7 presidency next year, and that's going to mean the UK has a very important role, and we will be focusing on getting agreement on Pillar 1.
Okay, that was Pillar 1. Pillar 2, let me just focus on what you might consider to be a design issue, but is equally, I think, a potential political issue. It's certainly something that's up for discussion at the moment. That's the question of carve-outs, including substance carve-outs. What's the UK position on them?
Well, there has been a lot of discussion amongst the inclusive framework members about carve-outs, and there were differing views, as you'd expect. Some wanted carve-outs for preferential tax regimes, others wanted carve-outs for industries or sectors. There was then a recognition that introducing carve-outs is going to undermine the effectiveness of the rule, and the stated aim behind Pillar 2 is to ensure a minimum effective tax rate is paid in each jurisdiction. But as you add in carve-outs, you start to move away from that. We've then had to weigh that concern up against the significant importance some have placed on building in what you describe as a substance carve-out. That is to say, a carve-out based on assets and payroll, a bit like the sort of carve-out that's allowed under the US GILTI rules, which might actually be where the OECD got the idea from. We recognise that's important to some jurisdictions. It's in the draft blueprint, and we're looking forward to see how businesses respond to that.
Okay, so it's not, it is an acceptable possibility, should we say, from the UK. A question that arises in that context is the relationship between the UK and its overseas territories like the BVI and Cayman. Some might argue that the UK's acceptance of the idea of substance carve-outs may be influenced by that relationship. What would you have to say about that?
About that, I'd say that you've seen the membership of the inclusive framework. You've seen that there are 137 jurisdictions there, and you'll know that they all have an equal say in the design of the rules. They have a seat at the negotiating table. That means they themselves, each one of those, are able to present their own views.
Right. Well, that's a very clear message. Angela, we could talk for hours and days about this topic, but unfortunately we have a limited time, so I think we'll have to call it a day there. It's been a pleasure having you on the show, and thank you for your open and insightful comments. And that wraps up this week's edition of Tax Takes News and Views from the IBFD. Don't miss next week's episode, where our guest will be Professor Itai Grinberg on the impact of the US elections on the international taxation system. For now, from Stuart Gibson and myself, thank you for watching, and here's hoping your week is not too taxing.